I wanted to start with exactly that, your economic prognosis, because I would imagine that informs you of your investment decisions. This is such a weird economy. One set of indicators tells us things are extremely good. The other set tells us almost the exact extreme opposite. What's the middle ground here?
Well, thank you, David, for having me. And I think the middle ground is to acknowledge that we are likely headed toward a growth slowdown. But I would push back against this narrative, this steady drumbeat of bad news that says, the U.S. is on the edge of a recession. There had been this view out there that said we're going to be in a recession in the next 12 months. And then I think people became increasingly pessimistic and said a recession was likely by the end of the year. And then even as recently as a couple of weeks ago, you had many people suggesting that we could be in a recession right now. And I would push back on that. I think we've got a longer runway for economic growth for the U.S. economy. So my odds of a recession in the next 12 months are relatively low. And an example of that pessimism, David, if you look at non-farm payrolls, of course, we saw a stronger June non-farm payrolls print, but all year long, if you look at the year-to-date figures, you can see the pessimism among forecasters where they consistently underestimated the number of jobs that the U.S. has been adding. And cumulatively since January, there are over 725,000 more jobs than the consensus predicted. So month after month, you see this pessimism basically growing. And my view is that labor markets, they remain strong. The evidence is there. The pace of firings is exceptionally low. And there remains still excess savings among households and on corporate balance sheets. So all in all, I would acknowledge the risk to Fed rate hikes. But if you think about the U.S. economy, it doesn't just generally fall off a cliff. There's a series of preconditions that will generally fall into place, and those preconditions have not been met yet.
And I'll take that analogy of the runway that you used, Joe, and juxtapose that against the Fed, because it's almost the same runway. Does that give the Fed essentially more room here to run when it comes to rate hikes? How high do you think they will go?
I think that inflation is more deeply entrenched in the U.S. economy, and it's going to require the Fed to take interest rate hikes up higher and the tightening cycle longer. So my own view is that Fed fund rates could exceed 4%. I think they could go above 4.5%, maybe even closer to 5%. And I also think the hiking cycle is going to go on longer. If you look at the consensus view, it's got rates topping out somewhere below 4% in the beginning of next year, and then the Fed cutting aggressively in 2023 and into 2024. So the market seems to want to trade every data point that we're seeing out there as if this is the last cycle where we quickly revert back to low growth, low inflation, and low interest rates. And the 10-year Treasury yield is kind of screaming that. But as we look at things like shelter and wages, and just generally the capacity constraints in the U.S. economy, I think inflation runs hotter. So I think it does require a bigger and longer central bank response.
Does that mean we're sleeping on the U.S. dollar then?
I am a secular dollar bull. My guess is that the pace of appreciation will slow. We've seen a little bit of a respite in the last couple days, at least. It's giving risk assets at least sort of a slightly better tone. And it's because other central banks will start to close the gap between, where they are and the Federal Reserve. We're likely to see the ECB begin hiking imminently. And so I think other central banks will start to close that gap. But generally, the dollar remains the highest yielding currency among major developed countries. And secularly, over the long term, in my own view, currencies reflect standards of living. And I think the U.S. relative to its major peers is probably in a better position as we head to this growth slowdown and what will ultimately probably end up in a recession. So for those reasons, I think we'll continue to see a bid to the U.S. dollar.
Okay, and as far as, I guess, asset allocation, financial assets, hard assets, short duration, long duration, what do you do?
Sure. Well, the first thing I'd say, David, is that as inflation goes up, it is more, deeply entrenched in the economy, in my view, and real rates adjusted for inflation remain deeply negative. I think the Fed's going to have to take them into positive territory across the curve. So I think the idea of duration management is going to be critically important for all asset classes. And that translates into cash flow and assets with the ability to grow cash flow. And I think one of the one of our secular or highest conviction views is in rental housing. And as inflation goes up, building new physical housing becomes more challenging. Housing's been undersupplied since 2007, and the demand for rental homes and apartments is strong and rising. So that, we look at this and with higher interest rates, it worsens the shortage of housing in the United States, and would-be buyers would maybe prefer to wait for home prices to come down. And it means that apartment rental markets, I think, remain secularly strong. And in faster growth markets, particularly in the South and Southwestern parts of the United States, rental homes, you see the ability to increase income, which is going to offset the potential for the cap rate spread to widen out. So I think rental housing ends up being an area that there's a secular shortage of housing. And as a result, I think it does well through the cycle.